Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young, and today is February 29th, 2024. Happy Leap Day. And today we're going to discuss why this bad economic data was good for stocks. Noticing today's move so far, and we still have a little bit to go in the day, but so far we have this very bullish move, solid bullish move, trying to close at the highest close for the year on the NASDAQ. This lift, this rise is going to push for a new record high as inflation remains pretty high based off of the indication between price ratio and of gold versus bonds. So the inflation hedge still strong, and we're pushing these up to these highs. Strong move in equities. So why are we seeing equities rally on inflationary pressure and on bad economic data? This week's economic data, as you can see, is all red or black, which means worse than expected or as expected. Nothing here is good. Over the last couple of days, we see new home sales dropped from 680 expectation to 661. Durable goods orders push deeper into negative. As we go further down, you see consumer confidence is sliding, and specifically, GDP is pulling back a little bit, but specifically today, we're looking at rising weekly unemployment claims, a manufacturing index, which is sub 50 and getting worse. Anything below 50 is contraction, and pending home sales dropping -5%. So durable goods orders, new home sales, pending home sales, all these big ticket items, all these expensive things that are going on, manufacturing and jobs are all showing bad data. So why is that exciting, bullish, and anticipatory of even higher equity prices in the markets? Well, to look at this, let's dig into bond prices. Let's look at gold prices. Let's look at the US dollar's value and discuss what this is possibly pricing in going forward. Having already looked at the NASDAQ, let's take a look at some bond prices. We'll both do the 10-year and the 30-year, as those are the ones that are kind of seen as the bigger indication of the overall economy. Starting out with the longest term, the 30-year, and you can see we've moved up, and kind of created a base down here. As this is edging slightly higher, bond prices are going up slightly, then that's also telling us that yields are coming down slightly. We're seeing bond prices go up and yields are therefore pulling back. Bond prices here, is that enough of a pullback to continue back into the bullish run? Are we going to see a flight to safety, a defensive play? Think about it this way. If we're seeing economic data that's showing warnings of slowdowns and economic weakness and jobs struggling and the big ticket items not being bought, it tells us that the consumers are stretched. If we see that slowdown being priced in, not as a run for the hills, but run for a return. Remember that bonds are still considered the safe place. And as we're looking at bonds being a safe place, if bonds are going to create a rally, specifically with the long-term 30-year, then we look at TYX and look for the TYX yield, and we're currently getting paid 4.3%. If you thought the economy was going to slow down, and yet you could lock in a 4% yield in a year that could be 5%, 10%, 20%, 30% correction, would you do it if it was the safest investment historically? And I think that's why we're going to see money push into those long-term bonds. Now take a look at the ZN. The ZN is going to play for two different reasons here, and that we're seeing the rally in the bond prices off the lows, a better rally off the lows, which means that yields are coming down. But this is representative of yields and borrowing rates for those home mortgages, yields and borrowing rates for consumers, generally speaking. The 7-year and 10-year are what we use to drive that. As we're watching this move higher through here, again, it's a flight to safety. If we take a look at the 10-year Treasury yield, you can see the 10-year Treasury yield is rolled over, and today's price action cleared out the last week and a half, 2 weeks of pricing. And so if we close below this level, it'll be the lowest close, arguably, since February 12th. So a 3-week low close would happen here if we just stay below this low here. That is an indication that we're rolling down in yields and up in bond prices. Now, that does not mean that consumers are suddenly going to say, oh, you saved me 0.2% or 0.5% or 0.05%. No, they're not going to chase that 0.0, 0.02, 0.05. If pending home sales, existing home sales, and durable goods orders all are sliding because it's too expensive, the yields are too high, interest rates are too high to borrow to buy these big ticket items, they're not going to chase a 0.05 move, which is roughly what that is in here. They're not going to chase that as a great savings. But what this is going to do is say, hey, we're going to see possibly cheaper money. If we're finally seeing the economy slow down and cool, then we are likely to set up for a higher likelihood of rates not going up, rates even cutting. And if that's the case, then we're going to see the cheapest money flow back into equities, and we're going to take risk on as investors, even if we're not taking risk on as consumers. So taking a look at that, let's go ahead and look at the ZQ as the Fed funds futures. And to do that, we're going to look at the actual difference in each of these month expirations and calculate what is being priced in. Pricing this in, what we do, and this will match the CME's tools pretty accurately, what we do is we look at these Fed funds futures dates, March, April, May, June, July. We take 100 and we subtract off this number. 100 subtract 94.86 is 5.14. So this is telling us July is pricing in a 5.14% rate. If we look at this one, it was pricing in a 5.19. So what we're seeing is that this number, as this number goes higher in June, July, August, September, the further we go out, this is starting to price in those rate cuts again. Not necessarily for right now. We're not pricing it in like we once were. As we're looking at the rates through here, we're pricing in no rate hikes, no rate cuts through April, May. A little bit of shift there, but by June we're starting to move that needle a little bit by about 0.15. Now 0.15 is going to be an indication of about a 50%, 60% probability of a rate cut by June, but we're not seeing 2, we're not seeing 3. In fact, by the end of the year now, if this is the economy slowing, by the end of the year, December, we have a 95.40, which means we have a 4.6% rate. To me, that is pretty wild that we're pricing in an entire 1% rate cut. We're not really pricing in even the quarter point cut with a high probability out till June. So that means that we're looking for 3 quarter point cuts from July to December. This is showing me that we are seeing a lot of slowdown. Now, this again does not fix the economy. This does not stop the economy from slowing down. We're getting a disconnect from what consumers are going to be able to spend to what investors are going to be able to buy with cheaper money. And we're now pricing in that lower rate. Let's go check the CME to verify it. Now, this is the CME Fed Watch tool. You can see our current rate versus what's being priced in. Nothing there. We go out to June, and now we see what is the probability of a rate cut, as our current rate is 5.25 to 5.5, so somewhere in between those two, and we see we've got about a 50% probability of one cut. That's about where I calculated out, about 60% as far as the way I would calculate it with the ZQ. But my interest is saying, what are we looking at for December? Are we pricing it in the same way that we're seeing it in the futures? Going out to December, our current rate is 5.25 to 5.5, which means we have a 0.6% priced in that we leave rates unchanged. We're now looking at 1, 2, 3 quarters of a point, like I was just talking about, highest probability, 3 quarters of a point, rate cuts by December as the highest odds. Now, it's still only 32%, but it's 32% here, 29 for 4, 12 for 5, and so we're pricing in a lot of rate cuts by the end of the year. To me, the market is now pricing in economic slowdown. And with that economic slowdown, again, we're not pricing in concerns about the economy. We're pricing in cheap money for investors. And therefore, that could give us a rise in bonds, a drop in yields, a drop or priced in cuts in the Fed rate, could and should give us lift to U.S. equities, specifically tech and small cap. Let's take a look here. If those rate expectations are accurate, then again, the tech stocks and the small cap are going to benefit the most from cheaper interest rates. So taking a look at the Russell is already pushing higher, and I would say this little probe today through this short-term resistance is a good sign, but I also want to get through these highs. If we can clear this high, I would call all of this either a cup and handle or an ascending triangle, something pattern like that, where I would look for this low, about 1900 to 2100, and I'm looking for a 200-point move higher. We're talking about 8 to 10% higher move in the Russell. So a 10%, 8 to 10% higher move in the Russell, all conditional on that lower interest rate. Watch for the lower interest rates, and therefore bonds up and interest rates down. The NASDAQ and the tech sector, and we could use XLK, but let's keep it with the NASDAQ futures since I'm looking at the future prices here. The NASDAQ futures should be similar. We already saw that the NVIDIA rallied up towards the end of the day and lifted the NASDAQ up towards the end of the day. Now this is going to be the highest close that we've had, but not the highest price. Therefore, we can watch for the same kind of idea. If we can clear this high, about 18,150, and we look at the distance in this consolidation and call it 17,365, what are we looking for? We're looking for about, let's call it 800 points. An 800-point move here, 600 to 800 points, depending on if you want to go off the closes or not. But at this point, I'm looking for a rally. If you're going shadow to shadow on the breakout, if we continue to see lower rate expectations in the future, we could be looking at 18,900. Now, in the last hour today, I had a target closer to about 600 based off of a Bollinger Band breakout. But if it's this price pattern, if we repeat this same move from low to high and break out, it could go as high as 18,900. I'm going to watch for that 18,600, but keep in mind that we still have the upside potential here. As we're looking at that move, if we see 600-point move, that's about a 3%. If we see a 900-point move from the current price, now we're talking about 4.5%, 5% move in the NASDAQ higher, and that will be lifted by the lower rates. Now, the one catalyst that could derail even the lower interest rates is the dollar's purchasing power. If the dollar's purchasing power is getting stronger and stronger, generally speaking, we expect equities to go down while the dollar goes up. If it takes less dollars to buy stuff, it takes less dollars to buy equities. But we're seeing this is not the case over the last couple of days. The dollar has been gaining against other currencies. So this is not a representation of the dollar's strength versus equities. It's representation of the dollar versus other currencies. We've rallied back up to what I can see as a key resistance area. Here, here, and here. You can see that consolidation and the barriers here. If we roll over, if the dollar weakens and we see bonds go up, flight into bonds, away from the dollar, lower interest rates, then equities should really accelerate. If the dollar rolls over here and loses purchasing power against other currencies, then equities are going to skyrocket and hit those targets easily before June this year. But if the dollar continues to strengthen, then be very careful, because that should slow down any ascent in U.S. equities. As the dollar gets stronger and stronger and stronger, then that should keep equities from going up too fast. So watch for the dollar, because it's kind of in this conflicting area, and we want to make sure that we're seeing some sort of shift or confirmation, one of the two, as we're watching for yields to continue to price in lower in the future and equities to price in higher in the short term. Well, that's going to do it for me. Thanks for watching, and we'll see you all again next week.